Hey, what's happening, guys? Dan Darrow here with another Options in Play video update. Smack in the middle of earnings and things are flying around. That's all you can ask for, right? When it comes to earnings, you want things to move, and as long as they're moving, we're happy because it gives us opportunities to make money. Today's video is another in the another. It's another video that is going to address kind of like a topic that came up uh, in the last couple days, and it has to do with strangles, hedges, and basically like playing like both sides of a trade, like bull and bear at the same time. And the question that came up recently, it's actually one that usually comes up, maybe every earnings season. So somebody will like ask me, why do you do a strangle if you have clear trade bias? That's the question that almost always comes up at least once every earnings season. And what they're saying is, basically, why do you pick up a put position in addition to your bull trade, right? Or on the opposite side, like why do you pick up a call position if you're thinking bearish? And I mean, this kind of deals with strangles, but also this applies to hedges too. But those are obviously just the fact that they're a hedge kind of is a little bit more straightforward in the reasoning behind it. Um, but let me. I basically wanted to take this video and to kind of like go over why like I'll do strangles a little bit more frequently than maybe just some directional bets. So when it comes down to it, most times or a lot of times when I'm analyzing stocks for good earning setups, I focus on names that are in slightly more defined ranges. I'm sure you've heard me talk about that. And really what it comes down to is that stocks that have huge moves right ahead of earnings can be a little bit tougher to read, meaning kind of be hard to gauge what expectations are. So think about it. Like if something has like a huge rally right into earnings, then um, odds are expectations are probably going to be really high and one-sided, right? Like if analysts keep raising their price target, the stock's screaming into earnings, they basically are setting expectations very high, and everybody's expecting like a blowout, right? Or if something, I mean, this is a little bit less frequent because you don't see it in this tape, but if something is just getting absolutely destroyed day after day after day, everybody's cutting their price targets, downgrading, and saying, like it's going to be a disaster. Then what happens is then expectations get very one-sided, and it's bad news could theoretically be closer to being priced in. Uh, so that's why when it comes to like earning setups, names that are in a little bit tighter consolidations, I like. I mean, every setup is a little bit different, so I'm not going to say just because it's in a consolidation I like it, but more often than not, names that I think have better potential are ones that are in a little bit better or tighter consolidations because you can get like explosive moves out of those ranges, out of those consolidations, right? Uh, and recent earning reports. So, what it did the last 2 to 3 quarters, I always talk about, kind of gives you a roadmap. Also, how the stock responds to those reports. So, is it beat and getting rewarded, or is it beat and selling off? Like, or is it move 10 points almost consistently every time it reports up or down, right? Like that kind of gives you an idea that lays out the roadmap of kind of what you can expect after the company reports this quarter. Um, and it gives you like the bias. So if like a stock is on like a good stretch of great numbers and it tends to be rewarded pretty well, then like you can have a bias, right? You form like a bullish bias. They've been blowing out numbers, the stock has been popping, so then you can form a bullish bias. But at the end of the day, there's still some uncertainty associated with it, right? Like they could, something could happen and they could miss. So yes, you can have a bias and you can expect something, but there is a degree of uncertainty that comes with these earnings. And I want to talk about Twitter because I think it's like an example of it. So this quarter was a good setup for Twitter because it was like a bounce back quarter, right? Um, you know, not notwithstanding like the entire environment, the last like 3 weeks where everything was getting hit. Coming into this quarter, you were thinking Twitter's in the position for a bounce back print, right? It had gone on like a really great stretch of good numbers, fantastic stock performance, right? And then the first quarter that it slipped up in a while, I think got smacked. So normally, kind of like Netflix, so like Netflix this quarter as well. Like normally, you're looking for a rebound print, so you want to see them like snap back with like a strong number. In this case, strong user engagement. So you have, in my opinion, like the bias of this trade going into the earnings should have been long, right? But there's some uncertainty, right? I mean, there's always uncertainty. What happened was it was consolidating underneath 30, right? So slightly weaker, kind of struggling to bounce. And then you have like the weak action in tech, the weak action in the market, and then names that have been like rolling over even after beating. So you have to acknowledge that even though you have a clear bias here, that there is potential that the stock could get hit pretty hard if they miss. I mean, there could be a breakdown into like the mid to low 20s. I mean, that's what the chart indicates. And it was priced in 4 points. So I mean, if it moved that, obviously you're looking at it moving to the low 20s. So that's why even though clear bias to the long side, risk reward and the recent action said Strangle was a smarter bet versus just a straight call position here. And like a Strangle, like the nice thing about it, right, is that you can skew the risk to reward to one side. So like when it comes to a straddle, odds are because you're buying like at the money options that there's not going to be a really sharp separation between the price of the contracts. But when you have a strangle, you get a lot more like leeway. So you can buy, say, like a call that's right at the money, and then a put that's like pretty far out of the money. So in that sense, you can skew the risk more in line with like your bias. So if you're bullish bias, then you could have design a trade that's maybe two to three dollars for every one on the downside. So you have like $2 to $3 risk for the bull and $1 risk for the bear. So you can see you can really skew. You can play around with like those risk numbers with the strangles. So it's even if you have a bias, you can still have a little bit of downside, and that really plays into hedges as well, right? So I know when I talk about hedges, it's kind of want the hedge, the way I approach hedges is that you want the hedge to be about a quarter to a third of the net debit of like the long swing. So a hedge arises because you're in a position and you want some sort of protection going into some event. So a hedge arises because you're already in it and you want a little protection. So that's why it's like about a quarter to a third of the debit of your current trade. But when you're initiating a strangle, if you're not on either side, you can think of it along the same lines, right? So you want the you want the one side where you're most biased on to have more risk versus the one where you're less biased to have less. So it's like you can have maybe like a quarter to the downside and 3/4 to the upside. So kind of like the same logic there. Um, and it's great to have conviction in an idea. Like you should have conviction in an idea when you get into it. Like you want like your ideas to be well defined. Like you want targets. You want have a reason to be involved in the trade, and so that means you should have like a clear bias, right? When it comes to these events, when it comes to these trades, but you always have to acknowledge that there's a little bit of unpredictability. So playing both ways, it by strangles or hedges, right? It still lets you have that bias, but it also gives you the option to capitalize if you read the trade wrong, or if something comes up and it moves like sharply opposite the direction you're expecting. And at the end of the day, it's all about managing like the debit of those sides. So you can play both sides, and you can still have a bias, and it just comes down to managing like the debit or the risk on the bull and bear side. So um, I hope this kind of answers some of your questions. It's something that comes up at least once a quarter when earnings season is going. So It came up just recently, so I figured it was a good time to tackle it in a video. Um, so I hope this helps. As always, like today, like you reach out, give me questions, comments. It helps me kind of tailor these videos more to what you guys want to hear. So I love to hear from you. Uh, so have a fantastic night, and I'll talk to you guys all tomorrow.